Hello everyone, my name is Anjani Kumar Khetan. I am based out of Bangalore in India. And in today's video, we will continue our deliberation from the previous two videos wherein we talked about what decommissioning liability is and how changes in decommissioning liability is dealt with if the entity is following cost model. Now today we will look at that if that property, plant and equipment to which the decommissioning liability is attached, if that PP&E is held under the revaluation model under Ind AS 16 or IAS 16 from an IFRS perspective, then in that case, if there is a change in the estimate of such decommissioning liability, then how the accounting is required to be done. That is something which we will look at today. Now, before we get into that, the treatment of the change in accounting treatment, it is very important that we just do a quick recap of how the revaluation gains and losses are treated under Ind AS 16 or IAS 16 from a IFRS perspective. The reason is because understanding of this requirement is very important to understand how the changes in the decommissioning liability is to be recorded. So let's first quickly recap how accounting treatment of revaluation gains and losses are dealt with in Ind AS 16 or IAS 16 from an IFRS perspective. Now we are looking at the first scenario where, let's say, asset is initially recorded at some amount, and then at some reporting period, first there is a revaluation gain, followed by there is a revaluation loss at a later point in time. So we are looking at revaluation gain, subsequently there is revaluation loss. In the next slide, we will look at the reverse case, therein there will be revaluation loss to begin with, and then there is a revaluation gain. So first look at the first scenario wherein you have to start with revaluation gain and then how the subsequent revaluation loss is being dealt with. And this is all given in paragraph 39 and 40 of Ind AS 16 from an Ind AS perspective and IAS 16 from IFRS perspective. Okay, so what the standard tells you, if you look at the combined reading of these two paragraphs, paragraph 39 and 40, let us say you have this property, plant and equipment which is recorded initially at the cost of 100 rupees, and the entity has determined that it will use the revaluation model. So revaluation model is followed with respect to this particular asset. Basically, it will be for the entire class of this type of asset. Okay, let's say building in this case. Then let's say at the end of year number 1, the cost of 100 rupees gets revalued to 120 rupees. That means there is a revaluation gain of 20 rupees. What paragraph 39 and 40 says that the initial revaluation gain of 20 rupees, in our case, this revaluation gain gets recorded to the credit of OCI. That means you will record revaluation surplus, and this revaluation surplus is accumulated under other comprehensive income. This amount does not directly go to profit and loss account. It is not allowed to go to the profit and loss account. Rather, it gets accumulated in the other comprehensive income, OCI. Now what happens? Your cost of the asset got increased from 100 to 220 at the end of year number 1. Let's say at the end of year number 2, you again do the revaluation, and this revaluation now tells you that the revalued amount of the asset at the end of year number 2 has gone down from 120 to 70. So from 120, now the value has gone down to 70, which means there is a loss of 50 rupees. There is a revaluation loss of 50 rupees. That's what this chart will tell you, that you have now a revaluation loss of 50. Now, what paragraph 39 and 40 tells you? That this entire 50 rupees need to be split into two parts when you are doing the recognition and the reporting of this 50 rupees. Now, the first part is that to the extent of the revaluation gain which already exists, that 20 rupees which you recorded at the end of year number 1, you can utilize this amount and offset. That means out of the 50 rupees, 20 rupees you will take out from OCI, and therefore the OCI will become 0 for this particular line item of the asset. Then you still have 30 more rupees for the losses. To your total loss is 50 rupees, out of which 20 rupees is something which you recouped out of OCI. So the balance 30 rupees basically goes to the debit of P&L. That's what the chart will show you here. So the other amount, the balance 30 rupees residual, is debited to P&L. That's how you do the accounting for revaluation gain when you have first gain, subsequently loss. Now what happens, if you look into the next slide, what happens if the situation is reverse? That means you have first revaluation loss followed by revaluation gain. Let us see that scenario, and then we will look at that change in the decommissioning liability, how that is being dealt with. So this scenario is revaluation loss, subsequent revaluation gain. Similar example, you recorded the asset at 100 rupees, revaluation model is followed. Now the change is, at the end of year number 1, this 100 rupees is revalued at 70 rupees. That means this office building, the value has gone down, and therefore 100 rupees value of the asset gets revalued to 70, and therefore you have a 30 rupees of revaluation loss. A combined reading of paragraph 39 and 40 will tell you that this 30 rupee loss on account of the revaluation is debited to P&L, to profit and loss account. Okay, because it's the first time initial revaluation loss. Unlike is what we saw in the previous case, whereas revaluation gain arising for the first time goes to OCI, doesn't go to P&L, but the loss, revaluation loss, goes first time directly to P&L, to profit and loss account. Now, what happens at the end of number 2? Now, the value of revalued amount of 70, assume now there is a gain and the value becomes 120. That means now you have 50 rupees of revaluation gain, which is 120 minus 70. So this 50 rupees gain is arising at the end of year number 2. How would you deal with it? This is also again split into two parts. What are the two parts? To the extent what loss you have already debited to P&L, the entity is allowed to reverse that loss by crediting the P&L in year number 2. That means by recording this reversal entry effectively over these two periods, your P&L gets neutralized and the net P&L impact becomes 0. But this reversal is allowed only to the extent of the losses which you have recorded in the past. So of the entire 50 rupees gain, you can't record the entire 50 rupees gain in the P&L. Rather, only a portion of it, which is 30 rupees, gets recorded to the reversal, by way of reversal to the P&L, and the balance 20 rupees again goes and sits in revaluation surplus under OCI. Now, why we have seen this? Because the understanding of this concept is very important, because the change in the decommissioning liability is also accounted for in the similar way. How it is? That is something which we will see theoretically over the next few slides. And also, I have given you some numeric example to explain how the changes are recorded. Now, in the next video, we will continue the series, one more video, and in the fourth video of the series, I will include one comprehensive case study which will deal with changes in the decommissioning liability when you have the asset being held under the revaluation model. Don't worry about that. That is something which we'll look at in the concluding fourth video in the next week. But let us see, having understood how the revaluation gain and losses are dealt with, Now, what are the key requirements? If there is a change in the decommissioning liability and the asset is held under the revaluation model, then what are the key requirements? How do you deal with such changes in the decommissioning liability? Let us see this by way of slide. Now, similar principle. Let us say you have a scenario where you had a mine, let's say a coal mine, and these coal mine has equipment. All of these mines and the equipment, let us say the equipment of these mines were initially valued at a cost of rupees 4 lakh rupees. So you have equipment in that mine of amounting to rupees 4 lakh that is initially recognized at cost. Now, for this mine, the mining operations has an attached decommissioning liability. And therefore, as we have seen in the earlier video, you have to estimate the present value of the decommissioning liability when the mines is surrendered or you wind up the operation. Now that in this example has been assumed that the entity has computed the present value of such decommissioning liability to be 1 lakh rupees. Now what happens? We have seen that this entire amount, 4 lakh plus 1 lakh, the entire 5 lakh would be recorded as the property, plant and equipment. So PP&E, when initially recorded, it will include both these components. So therefore, the journal entry will record is debit, property, plant and equipment. 4 lakh you have paid already by way of cash when you have acquired this equipment, and you create a liability provision for decommissioning liability to the extent of 1 lakh. That is the entry which you will record on initial recognition. Now what happens? Let's say at the end of year number 1, and of course we are talking about revaluation model being applied by the entity. Now at the end of year number 1, the entity revalues its assets. The entire PP&E, okay, consisting of both the equipment and the decommissioning liability. Revaluation is done at the end of year number 1. Now assume that the provision, the liability, there is no change in the liability. Ignore the effect of unwinding. This is something, just don't worry too much into it. In the comprehensive case study, which I will deal with next week, we will talk about this concept. For the time being, for simplicity, let's assume that this 1 lakh remains unchanged. There is no change in the 1 lakh. But the carrying amount of the equipment, the revised carrying amount of the equipment and the liability together now becomes 6 lakh. Why? Because now you are applying the revaluation model. So at the end of year number 1, though there is no change in the decommissioning liability, ignoring the unwinding effect, the total value is 6 lakh rupees. The original cost was 5 lakh rupees. So if you compare these two, you have now a gain of 1 lakh rupees. So therefore, at the end of year number 1, revaluation gain of 1 lakh you have to record. And as we saw the principle in the earlier slides, 1 lakh would be a credit to revaluation surplus that will be accumulated in OCI, and the corresponding debit will go to PP&E, because now your PP&E will be carried at 5 lakhs plus 1 lakh of revaluation gain, 6 lakh rupees. Now, what happens subsequently? Let's see this. Let's say, so now at the end of year number 1, the PP&E has a carrying amount of 6 lakh. But then there is a change in the decommissioning liability in year number 2. So at the end of year number 2, there's an increase in the decommissioning liability. Again, for simplicity, ignore the unwinding effect that we will see in the next week's video with case study. Assume that in this case, there is an increase in the liability. And that increase in the liability at the end of year number 2, so you had 1 lakh rupees, sorry, not this one, you had 1 lakh rupees of the present value of the decommissioning liability. Let's say at the end of this year, leaving aside this unwinding effect, this liability becomes 1,20,000. So therefore, you have an increase of 20,000 rupees in the decommissioning liability. Now, let us see this. Let me clear this. So now you have an increase of 20,000 in the decommissioning liability, ignoring this unwinding effect. Then, what will happen? Now, accounting for this 20,000 increase in the decommissioning liability depends on what has happened in the earlier periods. As we have seen how the revaluation gains and losses are treated. Even for the change in the decommissioning liability, accounting for this 20,000, it will depend upon what happened in earlier periods. Now, if you look at in our case, what has happened in earlier years? In earlier year, you have increased the value of the PP&E by 1 lakh rupees because you had a gain of 1 lakh rupees. Now you have a loss of 20,000 rupees. And what we need to look at, what happened in the previous year and whether revaluation surplus for this particular item exists. In this case, yes, it does exist because we recorded 1 lakh rupee of revaluation gain in the earlier year. So now what you will have to do, because your decommissioning liability has increased by 20,000, you will have to increase, you have to credit provision for decommissioning liability, and therefore the balance of this liability by recording this entry will go up to 1,20,000, which is what you needed. 1 lakh plus the increase of 20,000 by way of the credit which you are recording. The question is what the debit you have to do. Now the debit will depend upon what has happened in the previous years. Now in this case, because revaluation surplus did exist as at the end of year number 2, because of the recording of the revaluation gain in year number 1, and therefore the debit for this increase in the liability will be to the revaluation surplus. That means by recording this entry, your net balance in the revaluation surplus at the end of year number 2 will get reduced to 80,000, 1 lakh minus 20,000. And your provision for decommissioning liability will go up from 1 lakh to 1,20,000. Just to rephrase and summarize, as I said, paragraph 6, this paragraph 6 of IFRIC 1 and Appendix A to Ind AS 16 from an Ind AS perspective. This is the guidance given in all of these. What we saw is the guidance available in paragraph 6 of IFRIC 1 and Appendix A to Ind AS 16. Also, paragraph 6C gives you additional guidance. Paragraph 6C says that when you have this change, due to change in this decommissioning liability, if there is such decommissioning liability which is changing, then the entity via paragraph 6C of IFRIC 1 and Appendix A to Ind AS 16, entity is required to assess if the asset, the underlying PP&E, whether that also needs to be revalued, because the existence of the provision, the change in the decommissioning liability may indicate that the asset may not be at its fair value, and therefore paragraph 6C says that you need to assess if the asset also need to be revalued. And then if such a revaluation is necessary, then not only that asset, all the assets in that asset class need to be revalued. This we will continue and look at in the next slide as well. So if you go to the next slide, all we said is the accounting for change in decommissioning liability is dependent upon, what happened in earlier periods and whether a revaluation surplus exists or not. So let us see this scenario. Similar to what we saw, initial recognition at whatever number, then at the end of year number 1, you assume 100 rupees of revaluation surplus. And we have seen first time revaluation surplus gets credited to OCI, not to P&L. Then let us say in the second year, you have OCI revaluation surplus of 100, and let us say the decommissioning liability gets increased by 50 rupees. Now, you already have revaluation surplus which is higher than what the increase in your liability, increase in your decommissioning liability is. Therefore, what you will do, as we saw in the last slide also, the journal entry which you will record for this increase in liability, you will increase the liability for sure for 50 rupees, but the debit in this case will go to revaluation surplus because the increase in the liability is lower than the revaluation surplus for that particular asset. So revaluation does exist. Now, let us look at the other scenario. Assume if the increase in the liability is, let us say, not 50 but 125. Now what happens in that case? Obviously, For 125 rupees, you have to increase the liability without a doubt. But problem is what? Debit. Now, the debit for this 125 will again be split into two parts. To the extent of revaluation surplus which you have, as we saw in the initial slides, right, where in paragraph 39 and 40, I introduced you and I told you the understanding of that is important, is exactly the same. What are you doing? This 125 rupees of loss, effectively the revaluation in the decommissioning liability, out of 125, 100 rupees, which is already there in the revaluation surplus, you will knock off the revaluation surplus and make it 0, and the residual balance 25 rupees. This 25 will be debited to profit and loss account. So therefore, the debit will be either to revaluation or to the P&L, depending upon what happened in the prior period and whether revaluation surplus exists on this date or not. So this was the case when there is an increase in the decommissioning liability. Now, also let us look at what happens if there is a decrease in the decommissioning liability. So, you had a loss to initial recognition, and then after that, at the end of year number 1, let's say you have a revaluation loss which you recorded. First time revaluation loss, in our example 100 rupees, where does it go? It goes to P&L debit. So revaluation loss of 100 has been debited to P&L, and now there's a decrease in the decommissioning liability. Now this decrease, it is not increase, it's a decrease. It's like a benefit which you have in your liability. And therefore, if there is a decrease of this 50 rupees in the decommissioning liability, then you will reduce the decommissioning liability. Your debit will be 50 rupees and the credit in this case will go to P&L. Why it is going to P&L? Because this is lower than what you have already debited to P&L. You have already taken a hit of 100 rupees in the prior year, and therefore if your increase is lower than this 100 rupees, then in that case you will credit that 50 to the P&L. Now let us look at another scenario, that if this decrease in the decommissioning liability, if it was not 50 but say 125, then in that case obviously debit of 125 you will give to the decommissioning liability. The question is in this case where the credit will go. Same principle. Credit will go either to revaluation surplus or to P&L, as the case may be, depending upon what happened here. So out of this 125, 100 rupees, you will take it to the credit of P&L. Why? To nullify the effect of the loss which you recorded in year number 1. And the balance 25 is something which you will be recording to revaluation surplus in OCI. Now, there is one more additional consideration we have to look at, okay, in the next slide. So we'll see in the next slide what is the additional consideration which you have to look at, which is also required under IFRIC 1 and your Appendix A to Ind AS 16 when there is a decrease in the decommissioning liability. Apart from what you just now saw, let us see the next slide. Paragraph 6b of IFRIC 1 and Appendix A to Ind AS 16 says you should have this additional consideration also you have to look at. What paragraph 6b tells you is this, that in case the decrease in decommissioning liability is more than the carrying amount that would have been recognized had the asset been carried under cost model. Now, look at it very carefully. The asset, including the decommissioning liability in our case study, is under revaluation model. Now, this is an additional check which you have to do as required in paragraph 6b. Very important point. It says that if the decrease in decommissioning liability is greater than the carrying amount that would have been recognized, assuming if you would have recorded this asset under cost model and not under revaluation model, then assume in that case, then such excess. So decrease in liability, let us say, is 150, whereas the carrying amount would have been 100 if the cost model would have been applied. Then the excess of this 50 rupees, it is recognized immediately in profit and loss account. And this is exactly what is demonstrated in the chart alongside. So the carrying amount of 100 under cost model. This you need to compare that whether the reduction is in liability is, how does it compare? Now, if the reduction is liability is 150, the delta of these two, which is 50, goes directly to probable loss account. So that's what it says, that to the extent of this 50 rupees surplus is credited to probable loss account as required in paragraph 6b of the standard which we have been referring to, right? That is what you have to look at. Now, this series will continue, and in the next video, as I mentioned, I will include a comprehensive case study. If you remember, in this particular case study, we said unwinding effect, ignore. That's not the correct approach. We have to actually also look at the unwinding effect, because otherwise your numbers are not correct. I just wanted to give you conceptual clarity in terms of how this entire framework works. But when you have a decommissioning liability, that needs to be, the interest unwinding also has to happen, right? That is something which we will look at in the comprehensive case study next week, that if the asset and the decommissioning liability together is held under a revaluation model, then how do you deal with it? One case study, something which will be helpful for you to understand the entire concept, and that will complete our deliberation on this particular series on how to deal with changes in the decommissioning liability, whether it is held under cost model or revaluation model. And in the very first video, we introduce you to the concept of what decommissioning liability is all about. So this is what I wanted to cover for this particular video. My social media contacts are already here. This is the contact. You can scan these barcodes. By easily you will be able to reach out on my YouTube channel and the LinkedIn page. Please do subscribe to my YouTube channel, put comments, and also put in the comments whether any specific area or the topic you want me to cover, and then I'll try my best that subsequent videos, future videos, I will include on those topics. Thank you, and bye for now. Take care.